Okay, guys, we're going to go ahead and get started. Um, I am recording this lecture. Pretty much the process, assuming my software doesn't give me a hard time, is going to be to record the lecture and then post the lecture as you may have seen now. If you haven't been on Canvas in the last few hours, I am posting the lectures once I got things working here for Chapter 1. Chapter 2, our lecture from Wednesday is up there now, and so on. So today, I think we're going to go through the Chapter 2 quiz. So often the quiz will be a separate file, separate link to the YouTube for the actual lecture itself. And so we'll get a couple postings typically per lecture, but those will be up there. Okay. If you missed Wednesday, because I think I had like 7 people out on Wednesday, which is way too many for intermediate accounting. You probably got an email from me saying, hey, what's up? You should drop the class if you can't commit to it, etc. I understand we all miss a class here and there, 1 or 2, but I want to make clear, and I said this on Wednesday, I'm going to say it again, intermediate 2, intermediate 1 and 2, this is it. There's no cavalry waiting around the corner to teach you other things in accounting that you didn't pick up in college somewhere. Okay, the expectation of your firms, your potential companies that are going to be looking to hire you, is that you did your job in this class. So there is no, well, gee, maybe you can pick that up somewhere else or something. This is it. These 2 classes, 1 and 2, if you're putting any effort into any class, these are the 2. This one and the next one after. You should be at all costs trying to get an A out of this class. So I understand that things happen and you get sick, family members get sick, you have accidents, whatever. Okay, that's one class. But I'm going to continue to send those emails out when you miss class because you need to be here. I don't care how easy you think this material is right now, and it may be. I don't care if you think it's easy till the end. There's a chance that I may accidentally teach you something, and you should be here for that event. Okay? All right, so that's it on that speech. Just want to make sure we're on the same page. This is not an introduction. This is, what people are expecting you to know this stuff. Okay? All right. So that's the end of that speech, and I recorded it because I want to make sure that if someone's not here and they're watching the lectures online, they should still be here for class. Okay? All right, so let me go ahead and put myself in tablet mode. And my recollection, guys, was that we had finished up the slides for Chapter 2. Is that right? And we were about ready for the quiz. Okay, so my goal for today, well, first off, was there any question on that Chapter 2 example we went through? Remember, we had year 1 and year 2, and we kind of went through that. That's sort of like the peanut butter and jelly of, the accounting process. And I showed you the general ledger software. Did I go through that process? Or I said I was going to. I said it was too easy. It didn't have it. But you want me to show you the way a general ledger software works real quick? Okay, let me do that. You may sit there and yawn and say, okay, whatever. But let me show it to you just in case because it's good for you to have the appropriate expectation as to how you'll be doing if you're ever involved in a general, entering entries into an accounting system, an accounting information system. Often you see AIS, so we have a computer system, we have management information systems, we have accounting information systems, etc. And in the accounting information system, what you may run into is something called, which you'll probably hear about, is general ledger software. Okay, so what I'm going to do, I don't think McGraw-Hill will mind if I go to the other textbook that I use for my intro class and show you the way they have the general ledger software in there. Okay, so even though that's not our class and you can't access it, unfortunately, through the Spiceland text through this other McGraw-Hill book. It's called Wild is the author. Okay, so I'm just going to go to my Connect section and go to it's chapter 2. In that text also, or we go through the basic accounting process, and I want to preview. I think this shouldn't take us too long. I think it's the one I want to go to is question, I think it's 7. Okay, good. So they give us some very basic transactions here. This Casey Spade, I don't know why I'm putting it in tablet mode, starts up the company, blah, blah. And when you go to the general journal right here, okay, of course, as you well know, oh, sorry guys, I got to go to student mode or it's somewhat anticlimactic. So let me go to student view. Right. If I do it in instructor view, then I can't be God anymore, right? Because then I get to see all the answers before you do, and that makes me God, right? And so I have to have an instructor view. But student view, you sit here and you see some of the transactions, and I'm going to go back to that number 7, I think is the one I want to do. And then you see they give us these different things, and you can go ahead to the general journal, and in the general journal they of course show you the transaction, and she invested cash, I'm assuming it's a she, Casey, right, in the company in exchange for common stock. Okay, so first off, we need the account title, and so they give you a little drop down, and you can see the account title is cash, and you can see that the cash amount, you just enter the cash amount in, 107,750. Okay, and so we go ahead and enter that, and then of course we have to do the credit here, and the credit is going to be to what? We drop down, good, common stock, and of course debits equal credits, which by now you couldn't forget if you wanted to. And I go ahead and I make that, and I record the entry. Now when I hit record entry in a general ledger software, what happens? You look, and when you go to the general ledger, the ledger cards automatically post, right? There is no manually having to go in and post the debit, post the credit the way we were doing in that little example, which is sort of like the 1968 version. I mean, you'd literally have to start smoking indoors to be able to, get yourself through that. Okay, so there's some things we don't do anymore, right? Because we're smarter than that. And of course, when you look at the trial balance, it gives you the trial balance. Trial balances aren't nearly the vital link that they used to be. Trial balances used to be a big deal when you had to go and do all that posting in case the phone rang and you took a call and you had posted the debit and forgot to post the credit and then went on to the next transaction, and then the trial balance didn't balance, the what hit the fan, and everybody tried to figure out why the trial balance wasn't balancing. Nowadays, a trial balance is going to come up more in the context in that there's probably going to be adjusting entries that have happened at the end of the accounting period, but management may say, hey, can we see the trial balance now? We know you're still working on it, but we want to see what things look like right now before we finish up. So they may ask for a trial balance in that manner. You would hit the button in the general ledger software, it spits out a trial balance, and everybody knows you're still working and making adjustments at that point. Okay. Now, the beauty of general ledger software is after you've made all your adjustments, you're satisfied that everything is where it's supposed to be, Then your financial report, your income statement, of course, right now everything would be zero in this case because they only had the one transaction affecting the balance sheet, the issuance of common stock, right? But your income statement, your balance sheet, your statement of retained earnings is just sitting there waiting for you to print it off through this general ledger software. So that process of posting the entries, and then we had to take all the entries off of the ledger cards, put them in the form of financial statements, do the closing entries. I mean, you'd still do the closing entries in the general ledger software, but it's not that tedious process that we talked about. So you should just keep that in the back of your mind. And probably every general ledger software you run into in practice is different. You'll be trained in that in any software, but you should know that that's the way things are operated these days. Okay. Any question on that? Okay. I was going to say I was on an audit a long time ago when I first started. What they used to do, state of California said that a CPA had to do an audit from soup to nuts, from beginning to end, plan, report, conduct the audit procedures, everything. They had to do that in order to get the license. So I got assigned to an engagement because most, clients that my office, the GAO, had were these tremendously huge clients that nobody could do on their own. So they would work for us when we were ready to demonstrate our CPA for our CPA license. They would get us a small audit. So they put me on the House of Representatives Child Care Center. Okay. Now I'm assuming that what I'm saying to this group over here is completely uninteresting, right? So do you want me to skip the story? Is that what it is? Okay. So I'm on this engagement for the House of Representatives Child Care Center. It's a little small 501c3 corporation, $150,000 in assets, something that somebody could do on their own. The problem is that they had a nurse doing all of the accounting because they had to have a nurse on site at all times for this child care center. I guess in case one of the kids hurt themselves or something, there's a medical person on site. And she also did all the bookkeeping. Well, the way she kept all of her records is an Excel spreadsheet. And she had the different columns affected by different accounts by the different entries, but she didn't know debits and credits. So I've got this mess of not even a general ledger. So what I did was I got a general ledger software, and I told them I'll be back in the office on Monday to do the audit. And that Friday, I took the train from Washington, D.C. to Boston to spend the weekend in Boston. On the train on the way over, I entered every single transaction into a general ledger software so that I had a general ledger to audit by the time we, got the things rolling. Now, it's okay to do that as long as you still, from an auditing standpoint, from an auditing standard standpoint, as long as you still get behind the supporting documentation for all those transactions. So if she wrote a check and I sampled that check, I still needed to see that check as part of the audit process over that. Okay? So these general ledger softwares are there. They're very powerful. They're very useful. I'm sure you'll run into one at some point in time. This is just an academic thing here. This financial statement impact is purely academic. Okay. Okay. All right. So that's that. Let me go ahead and take a look at now homework and not homework, but the quiz. Okay. You should be, that's a good point. I got to put up the homework assignment for Chapter 3. I forgot to do that, but I will do that. Put up a homework assignment for you that bought the software for the homework. Okay, but you don't have to get that. I think it's not a bad idea to buy the textbook, though. But anyway, I've talked about that enough. So let me go ahead and, is there any question on the homework? It is not required, right? It's optional that you do the homework in there, but some of you have. But I do suggest that you get the textbook. Okay. Anyway, so I want to go to the quiz for Chapter 2, and I just want to point out to you that there are 2 quizzes. Oh, sorry, I'm jumping around a little bit. Also, if you want to watch the video of more, if you just can't get enough of that general ledger software, there's a video of me talking to myself, putting in a series of transactions in there. If you're just dying to see more of that. And then under Chapter 2, I'm in the wrong class, huh? Okay, thank you. It's like, what on earth is going on here? I'm losing my mind. Okay, so maybe I didn't put those videos. You'll have to request the videos for the software example. I'm sure you're all dying to see it. But you see, there's two homework assignments. So I'm going to be pulling from these two assignments, okay, today as we go through this. And if I ever stop blabbing over myself, we will be able to get to those here sometime this century. Okay, so let me look at this second one first. Let's do this one, okay? And I'm just going to go randomly, and then remember, guys, you should be looking at these before class so that if you do have questions about any of them, you can bring those to me, because I'm not going to sit here and bludgeon through every single question every time we meet, because we've got bigger fish to fry than some of these introductory chapters. But let's just look at number 12 here. This is from the file titled Second Chapter 2 Homework Practice Quiz, whatever. Okay, so it's the quiz. Okay, so the income statement for the month of June 2013 of Camera Obscure contains the following information. The entry to close the revenue account includes. Okay, now this one should be a piece of cake, but let's just do the whole entry. And that we're going to sit there and do what? Debit revenue to close it, right? For 7,000 and credit the income summary, which is the answer to this question. Okay, so that's pretty easy. The entry to close the expense accounts includes. Okay, let's do that one. So when we close the expense accounts, we're going to do what? We're going to close them an account at a time. So you make your closing entry account by account, don't you? Okay, so we would have credited salary expense, rent expense, advertising expense, supplies expense, insurance expense. Each one would have had their own credit, right? And so then the answer to this is to do what? To credit rent expense, and then we would debit income summary for the total of those rent expenses, right? And then the difference gets closed out to retained earnings, okay? Okay, good. Any question on that? All right, good. So let's go ahead then. Some of these are just basic adjusting entries. Let's go ahead and look at this salary one, just to review on salaries, because I don't think I walked you through salary accrual in the slides, because it's, again, very basic. But let's just look and see if we can learn from this particular question. Okay, so Pioneer paid salaries and wages on Friday, October 26th. And with a question like this, guys, I tend to just go ahead and make myself a calendar. If the problem is telling me that Friday is the 26th of October, I don't argue with the question. No, it's not. Friday is the 28th, first off. Okay, so we just go with what they say. That means that what? Saturday is the 27th, Sunday is the 28th, and then probably relevant to this question now, Monday becomes the 29th, right? Okay, so the next payment of salaries will not occur until Friday, November 9th. Now, I think the reason I wanted to mention this question, I think there's a typo here. I think this should be November 2nd, I think. Yeah, but it's not. That's the typo with this question, because I think I either changed it or whoever was doing it made a mistake and went on a 2 week. Yeah, so it could have been, but you won't get the answer. So it's a 1 week pay period. Okay, that's the problem with that question. So Tuesday is going to be what, the 30th? Okay, to make this question even more scary, Wednesday would be the 31st. Thursday then would be what? The 1st, and Friday would be the 2nd. Good. Okay, so if we're sitting here and we're paying what? People $400 a day on October 31st to close the month there. What is this? To close the month, you would have 1, 2, 3 days still falling in October, right? And then the 3 times the 400 would give us the 1200. So there was a typo in that question, was the problem. Okay. And then using the same facts as question 16 on October 31st, what entry would we make? We would clearly do what? Debit salary expense, credit salary payable for the 3 days that fell in October, right? Okay. And then when you take a look at the next question, I think there's one more. What journal entry will we make on November 2nd? Now we got the correct date, November 2nd. And on November 2nd, you have what? You have the 2 days, November 1st, November 2nd, that have fallen in November now, right? So on November 2nd, you'll debit salaries payable for those 2 days, 400 times 2 equals 800. You debit the salaries payable, but that's for the 3 days, the 29th, 30th, and 31st that fell in October, right? And credit cash, of course, for the full 2,000. That's the 5 days times the 200. So that typo there might have driven you a little crazy. I'm sure you stayed up all night staring at the ceiling saying, how could it be November 9th, right? Okay. Okay, good. Now I want to take a look at a couple of these. I'm going to try to do this as frequently as possible where I dig into my CPA software and borrow a couple questions from the CPA software just to make sure that you're getting a sense as to what, in my opinion, is really your next academic endeavor after you complete your coursework here at San Jose State. I would highly recommend you all shoot for the CPA exam, even if you don't plan on being a CPA. There's absolutely no reason to come out of San Jose State with all this knowledge that's got you right there to be able to take the CPA exam and somehow not take it. Okay, CPA exam passing is a game changer. I'm telling you, even if you don't go officially into public accounting. I did not go into public accounting. I went into government, but I had the CPA exam passed. I put that on my resume. That probably helped me to get the opportunity. And then when it came time to put people on the assignments that would actually qualify, like that House of Representatives Child Care Center job, there was a line of people trying to get on that. I went to the front of the line because I'd already passed the exam. You had some people that hadn't passed the exam yet. Then once I got the CPA, there was somebody at our office who went to Brown University. And Brown University, if you don't know, is a big Ivy League school, and they were very proud of their little, play toy there that they had gotten from, Brown University, because they didn't always get people from Ivy League schools. So when it came time to go on a particular assignment, that was a pretty good assignment, pretty good opportunity, looking at accounting issues. At GAO, we look at a lot of stuff, but this particular job that was going to be a big assignment, looking at how banks accounted for their loan loss, Congress was somewhat interested in that. They were going to put the Brown University person on. So my boss calls me in and says, well, look at this email, and it's Washington, D.C., asking my boss how Washington knew about John Lord, because it says in the email, why are you giving us so-and-so from Brown University? John Lord just got his license. Why aren't you putting him on the assignment? This is to the regional manager, and the regional manager is asking my boss, how do they know about John Lord? And, of course, my boss got the smile, the look of the cat that ate the canary, pointing himself. I'm the reason they know about you. He's letting me know who's buttering the bread. So CPA is somewhat of a game changer, guys. So if it's not in your plans, you should seriously take another look at that. Okay? All right, so let's look at this one. Roro Inc. paid $7,200 to renew its only insurance policy for 3 years on March 1st, year 5. The effective date of the policy. At March 31st, year 5, Roro's unadjusted trial balance showed a balance of $300 for prepaid insurance and $7,200 for insurance expense. What should be reported for the prepaid insurance and insurance expense in Roro's financial statement for the 3-month ended March 31st, year 5? Okay, so what's happening? You may see something like this in a client that doesn't understand accrual accounting. They know that they paid the insurance expense, so they do what? They simply debit it. They paid the insurance premium. They simply debit insurance expense for the entire amount, right? So what would have happened? There would have been this balance in there In the insurance, it says we're adjusting on balance 300. Prepaid insurance is 7,200. They simply debited the insurance expense for what? For the entire payment of 7,200. Is that right? No, that's not how we should have done it. So you, CPA, accountant, accounting degree from San Jose State University, if financial statements are sick, you, doctor of financial statements, know how to cure them through what? Through adjusting, correcting journal entries, right? Okay, so we come over here and we take a look at this, and probably what happened is they had the correct amount in the prepaid at the start of the month. They had in the prepaid account what? 300, but then what? If they renewed their only policy on March 1st, that means that 300 must have expired. And if expired, the correct journal entry would have been to do what? Credit the prepaid for 300 and debit insurance expense good for $300. And that would have covered what? That would have covered the policy that expired on February 28th, 29th, whatever it was. It expired on March 1st. They bought a new policy, right? Then what they should have done was they should have gone ahead when they bought the new policy and do what? Debit it for $7,200 credit cash, and they have a prepaid beginning March 1st at $7,200 when they bought that new policy, right? Now, if it's a 3-year policy, 7,200 times how many months? 36 months. Good. Comes out to, I'm doing this in my head from recollection, guys, but that's 200 a month, right? Okay. But then they ask me what? At March 31st, so the first of those 36 months has gone by, hasn't it? Okay, so there should have been another what? Another credit to the prepaid for 200, debit to the insurance expense for 200, and so that would have given me what? The correct answer as C, $7,000 in the prepaid, 500 in the insurance expense, right? Question? How I got the 7,000? 7,000, the debit and this credit cancel themselves out, right? So that zeros that? Yeah, and then you're left with 7,000. Okay, guys? So you get to a point with this stuff where, this is why people think that you're performing magic tricks. Okay, when you go into a client and you see a mistake like that, you don't go and start slapping people and saying, what'd you do? Okay. You just sit there and you say, okay, I see what you did. Propose the adjustment, give an explanation, and go from there, right? You look like everybody's friend. The 200 right here, credit to the prepaid and debit to the insurance expense. Because when they bought the policy, they paid $7,200 to renew a 3-year policy at the start of March. So that's 36 months, and then 1 month of those 36 is expired, right? At the 31st. So we debit insurance expense on the 31st for 200, credit the prepaid. So this credit and this debit are two sides of the same entry. I would call it, you are to read through the adversity of this question, okay? In the CPA exam, there's 2 things they're testing. One is your accounting prowess, but the other part is your ability to be an auditor. At the end of the day, all the CPA does is allow you to audit financial statements. What this problem is half designed to do is have you spend 5-6 minutes with it trying to come up with something and not be able to answer it because of its ambiguity. That's why I tell my students when you're doing CPA stuff, look, it can't be what? It can't be 73. It's not going to go up does it really make sense that there would only be 300 in there, and I could probably, 7,300? That doesn't make sense, and I could probably narrow you down to a 50-50 through this if you got stuck, okay? But what you're supposed to read through this is that it says the effective date of its policy. To renew its only insurance policy for the 3 years on March 1st, year 5, the effective date of the policy means it's expiring on that date. So there must have been an expiration that happened on March 1st. And if you want the insurance expense for March 1st, you got to accrue that expense for that first 300.
Just the numbers not matching up are a little loose. I would have thought that for January and February would have been $400, but I guess they had to got their raise and retweaked.
Yeah, they're saying that if you have to assume that if there's 300, then the prepaid was correctly stated for the 300, and the 300 is expiring at this point. Yeah, you're trying to give it 3 months. You're thinking maybe they adjusted at the end of last year.
That 300, I was trying to figure out how like the 300 doesn't really match with the current monthly rate unless I get that it's a new policy.
It's a new policy.
New policy, new rate.
Yeah. Yeah. So half the moral of this question is if you get stuck on a question, you start running out of time. This is a good question to mark. And then if you run into trouble, narrow yourself down to a 50-50. And that's half the moral of this question. Okay. Okay, good. Let's take a look at another one. This one should be a little more straightforward. Okay. Dana Company officers compensation expense account had $224,000 on December 31st, year 1, before any appropriate year-end adjustments relating to the following. No salary accrual was made for December 30th and 31st, year 1, salaries for the 2-day period totaling $3,500. Should we make an adjustment for that? Do we need to make an adjustment for that? Hello? Right? They've got 224,000 sitting in there already. And no salary was made for the last 2 days of the year. Are you supposed to? Yes, you are. So we need to add that, don't we? Okay, good. And then year 1 officers bonus of $62,500 were paid on January 31st, year 2. Does it matter when they paid it? Under accrual, we take it in the year that it's related to, right? And so we have to make an adjustment for that. So we got to add that $62,500. And I think when you add those two, you get the right answer here. This $290. Yep. Okay. Stay awake, guys. This is not sleepy by time. Sleep in your history class. Okay. All right, good. Let's take a look at this next one. I know history's so interesting, right? And maybe your boss will be a history major who became an accountant. Okay, but right here. They won't want to. I don't care how interesting you are. If you can't do this kind of stuff, no one's going to want to talk to you at your next job. At your job. Okay. All right. Good. Cap Corp reported investment interest receivable of $38,000 and $45,600 January 1st, December 31st, respectively. Everybody knows what respectively means? You go with the first number first. Okay. All right, good. During the year, cash collections from the investment included the following, blah, blah. What should be the interest revenue? Okay, now step 1 of this question is to realize that gains from investments are not interest revenue. They are gains from investment, right? So we have to first know that we have to categorize this correctly. This is simply to distract you here, isn't it? Okay, then what? Then you'll see questions where they give you the beginning balance. We're doing what now? Interest revenue is what we're asked here. Okay, they give you the beginning balance, which was what? 38,000, January 1st, December 31st, respectively, means this is the January 1st beginning balance, right? 38,000. That's the beginning. They gave me in this question what? The ending balance. That's a D. So ending balance here is 45.6. Thank you. 46.5, because that would have driven me nuts when it didn't work. Okay, great. 46.5. Okay, so you've got that. Okay. Then what? Then they tell me the what? The actual cash collections. I mean, they want the cash collections. The okay, thank you. They give me the cash collections, right? Well, cash collections are going to be what? Going to be the subtract from my interest, and this is interest receivable we're analyzing. Beginning balance of interest receivable, ending balance, subtracts our cash collections, aren't they? So they tell me that the cash was what, 152? Now what you want to do, and I'm going to need help with a calculator here, is that you come up not with subtract, but a subtotal. And so you need to add up to get this subtotal. 46.5 plus the 152. 46.5 plus the 152 gives me a subtotal of how much? Huh? 617,000, you say? Okay, good. So I've got this 617,000 subtotal here. Guys, don't do anything without a calculator. The time of in your head playing around with the numbers just to try to do them quick is over. I'm sorry? 198,500? Okay. Okay, good. So you get this 198,500, which is the subtotal. Now, how did I get from 38 to 195? I had to do what? Add, and I would have added interest revenue, right? Don't you debit the interest receivable and credit interest revenue for accrued interest for the period? And so what does that come out to? And you do another little side calculation, which would be the 198.5 minus the 38,000, and your calculator tells you what? 160,500. Okay, good. So you start out with your beginning balance and your interest receivable. You add your interest revenue for the period. That would be your total receivable, assuming all your cash collections came after you have accrued all your interest, right? Just to be able to answer this question. You subtract out the actual amount of interest you're collected for the period, and that gives you the ending balance. But here they gave us the ending balance, didn't they? They gave us the subtract, the amount of the collections, so you could squeeze your way up and come up with the interest revenue in this question, right? Question? Yeah. We ended up with 46.5, right? In my interest receivable. And part of the maybe confusion might be that I called it interest revenue, and I meant to call it interest receivable. It's interest receivable. You ended up with that, and you have what? You have the cash, which was the subtract. So what number did you subtract the cash collections from to end up with 46.5? And the way you get that is by adding those two numbers together. 46.5 and 152 gives me this number. To get the, 198.5, which I thought you were asking me for. The 198.5. Okay, so it was adding these two numbers. And then I just described it coming down. If you started with 38, answer the question, interest revenue means I would have built up a balance of 198.5 in the interest receivable. Subtract the cash gives me the ending balance, right? You want me to explain it again? Okay, huh? Okay, hang on. I'm going to do it this way. And I know you may understand a lot of this, but I just want to do it this way. In part because I said the wrong thing at the beginning of the question, so just to clear up any confusion. We have I'm going to put the screen up so they can see on this side. We have interest receivable, and we start the year with interest receivable. And I'm just going to do the balance over here of 38,000. Okay. Now the question gave us the ending balance, but I'm not going to put it yet. Okay. I'm just going to show you the way this theoretically all could have gone. And then let's say I have to accrue my interest receivable, and if you're losing track, where are we now? In Chapter 2, we were talking about making adjusting entries for accruals and that sort of stuff, right? So during the year, I would have debited interest receivable for 160,500 and credited interest revenue for 160,500. That would have given me, when I went ahead and debited the interest receivable for 160,500, that would have brought this up to the subtotal that I was trying to get here, which is 198,500. So the way you get there is by adding, but if you add these two together, which is the ending balance, you get what it would have been up to. Okay, and then the problem told me that I collected cash, and they tell me of 152. So I would have debited cash for 152. I would have credited interest receivable for 152, and when interest, I said receivable, but I wrote, thank you. I would, because I will say one thing, write another, and do a third. Okay, so thank you. I credited interest receivable for 152, and when I credit interest receivable for 152 and I post that over, that gives me what the problem told me was the ending balance of 46.5. Right? So, hey, it had gotten to 198, hadn't it, before I subtracted the 152? So since they gave me this, if I add this to this, I get this, don't I? The 198. And then if I want to say, well, how'd you get from 38 to 198.5? Well, you had to add 162.5 to it, didn't you? And that 162.5 or 165, whatever it is the answer to this question. It's the interest revenue, right? Okay. Now, the burning question may. Okay, sure. The burning question may be, well, John, on my exam, how many of those are you going to give us? I mean, is the exam going to be made up of all questions like that? Answer is no. Okay, I'm going to tend to give you some that are easier than that. I might give you one of those, maybe two of those or something. I'm not going to litter the whole exam with those, but I do think it's my responsibility to make sure that you're aware of what's coming, which is an expectation that you can kind of maneuver through things like that. And I will test you at that level on a couple questions. Okay. Any other questions, guys, about any of these? Okay, I got the sense, I could be wrong, that you didn't bother to look at any of them homework questions, and that's why you don't have any questions about them. And if that's the case, you're not doing your job. Your job is to look at these like I instruct you to at the end of class. And if you don't believe me, go back and listen to the tape. I told you we would go over this next time, and you need to be looking at these so that if you do have questions about any of these more basic ones, you can ask me so that you're not sitting there on the exam the day after the exam and saying to me, you didn't ask, you asked us different questions. Because then I end up showing you that some of the questions were the exact same questions, and other questions were the exact same questions with slightly different numbers. And then you feel like, oh, okay, I missed an opportunity for an A. Okay? I know, it just chokes me up too. You okay? Just the thought of it. Okay, good. Any questions, guys? Okay. All right, good. So let me go ahead then and jump myself into, I thought I opened these already. No, I did. I want to do the slides now for Chapter 3, right? And I will put the homework assignments up for Chapter 3 as well. I just forgot to go into. Oh, that's the quiz. I don't want that. Okay, good. Let's go ahead and let's look at the slides for Chapter 3. Thanks, Ben, for helping with these questions. I don't know why it says Business 2220B, though. What is this class? 121A, so don't worry about that. Okay, it matches up. And I always adjust the slides accordingly and add some things in there. As a practical matter, guys, your best bet is to look at the slides as close to the start of class as you can. Okay, you'll probably see a little difference if you had printed them out before, because I cannot stop tweaking my presentation prior. So as I'm prepping for the class, it's almost inevitable that I'm going to come up with an idea of something else. Okay, so, okay, I apologize for that, but I can't stop myself. Okay, so we're going to talk about the balance sheet, and obviously you guys knocked it out of the park, the little example of the magnets that we had in here. Balance sheet is assets equal liabilities plus our stockholders' equity, and I have to keep saying to my introductory classes, because they keep wanting to put revenue on the balance sheet. I'm like, guys, it has the word balance in it. What balances? Something has to balance if it says balance. Assets equal liabilities plus stockholders' equity, right? And that has to balance, okay? And it's obviously as of a specific date, okay? And it's going to give us information about resources, our assets, our obligations, which are essentially what? Our liabilities, and then our remaining equity. Okay. When we group our assets and liabilities, we tend to, right now we're talking about assets, group them by their type, their function, their what? Their financial flexibility, their liquidity. And you guys did a real good job with the magnets listing the assets in order of liquidity, right? Okay, so when we take a look at these elements, which we studied in the last chapter, and if we're going to put something as current, that means that it'll be consumed within the operating cycle. Okay, now for practical purposes, operating cycle typically does not extend beyond 1 year. For most businesses, operating cycle will not extend beyond 1 year. So any asset that would be used up in 1 year would be considered what? Be considered current. Of course, that is for most businesses. So that's the rule of thumb. But the more technical way of looking at that is how long it takes a company to turn its inventory into cash. That is the operating cycle. Okay? So if you're a sushi restaurant, should it take you longer than 1 year to turn your inventory into cash? If it does, please do not eat there. Okay, so that means that for a sushi restaurant, they would use up a current asset in what, a year, or a current asset would be that which would be used up in a year's period of time. Okay, not longer than a year. Okay, because their operating cycles, whichever longer, their operating cycles much less than a year. So we would use 1 year to define current asset. Okay, 1 year of the operating cycle, whichever is longer. Since the operating cycle is shorter than 1 year, then we'd use 1 year for a sushi restaurant, right? Okay. Now, if you're a winery and you have, I don't know, grapes on the vine or whatever, I don't know, in the wine business, I don't know when they start counting their inventory. So let's just say you have grapes on the vine. Will it take more than 1 year or less than 1 year to turn that into cash? More than 1 year. Good. So a current asset for them, what? Could extend beyond that, what? Beyond that 1 year rule of thumb, because their operating cycle is clearly longer than 1 year, right? Okay, so it's what? The operating cycle, which is how long it takes them to turn their inventory into cash, or 1 year, whichever is, everybody? Whichever is longer. Okay, Good. All right, now you go ahead and when we look at our typical categories of current assets, cash and cash equivalents. Okay, now you say cash fair value. What the heck? Obviously, cash is fair value, right? But we'll talk about cash equivalents. Cash equivalents are things that are so near to cash that we count them with cash. Now, we don't get too much into the statement of cash flows in this class, but it's significant to the statement of cash flows more than anything, in that when you report the change in cash for the period, it's the change of cash and cash equivalents. Cash equivalent are items that are so near to cash, we count them as cash. For example, a Treasury bill is often considered a cash equivalent because what? What happens if the federal government defaults on its debt? Treasury bills. What happens? The federal government defaults on its debt. I don't know. Okay, it'd be the biggest, baddest thing that's ever happened. They always play games saying, "Oh, we're gonna just default on the debt." And it's kind of like, you ever seen the movie Invasion of the Body Snatchers? Like, there's these people that are like coming, these plants come and take over my body. And then first I was John, and then the next day I'm saying all kinds of weird things that you're like, how could he possibly? I'll be saying, you increase an asset with a credit, and you'll be going, huh, what happened? He's not John anymore. Okay, so these people that get taken over by some sort of pod creature, some sort of plants, start walking around going, it's okay if if the federal government defaults on its debt, it won't hurt anything. And you think, oh my God, the plants came and took my friend. They're not my friend anymore. Okay, just lose that friend if they say that. You can't sit there and say that it doesn't matter if the biggest, baddest financial country there's ever been turns around and all of a sudden stops paying on its debt. Okay, for example, in your finance class, they have what? They give you the risk-free rate of return as part of your capital asset pricing model. Well, throw that book away. If you think it doesn't matter that the federal government defaults on its debt, just burn that book then, because you don't need it anymore. Okay, so it's a big deal if the federal government defaults on its debt. And they say, okay, if you've got a relatively short-term treasury security obligation of the United States government, we're going to call that cash. Okay, so we call that, for example, cash equivalent. Short-term investments, receivables, inventories, prepaid expenses, all tend to be, typical current assets. Okay. Okay, good. Now you come over and we talk about cash equivalents. Okay, and cash equivalent is generally considered to consist of currency and demand deposits. Your savings account, your checking account is still cash. Okay, and then what cash equivalents are also cash equivalents are short-term, highly liquid investments that will mature within 3 months or less. Okay, and a company has to disclose any restrictions or commitments that it has on its cash. Okay, now let's just go back to cash equivalents. Let's look at that first, and then we'll talk about restrictions in a second. Okay, now when you look at cash equivalents, are short-term, highly liquid investments. Didn't that come up on another slide? Hang on, guys. Bear with me for a second. No? Okay, so I'll just do it right here. Okay, cash equivalent. What happens? When you have a cash equivalent, you're not going to let me write on this slide? That's what's happening. Pen doesn't want to let me write on the slide. Okay, we'll do it right here. Okay, so when you take a look at cash equivalents, okay, and it says a highly liquid investment that will mature within 3 months or less. Okay, now when we tell you that it's going to mature within 3 months or less, that is from 3 months or less from the date the purchaser purchased it. Okay, so from date of purchase. Okay, so what happens? Let's say I have a T bill, and T stands for Treasury, a Treasury bill, and it is a 6-month T bill. Okay, and it is purchased by company on um, what date do I want to make this? I'm going to make it 12 month. 12 month. And it is purchased by company on 1/1/18, and obviously if it's 12 months it's going to mature on what? I mean 1 year, it's going to mature on 1/1/19, right? So it'll mature on 1/1/19. Okay, now that's a 12-month T-bill. Now I have, that's T-bill 1. T-bill 2, 12-month, but now it's purchased 12-month, and it matures on also 12, 1/1/19. But now it is purchased on 12/1/18. Okay, so let me read this back to you because it's kind of funky up here the way I wrote this. T-bill 1, 12-month T-bill. They purchased by company on what date? 1/1/18. It obviously matures on what? 1/1/19. T-bill 2, also a 12-month T-bill, so it matures on, I'm telling you, 1/1/19. But in this case, they purchased it on what? 12/1/18. Okay? So my question to you is, which of these are cash equivalents? Is T-bill 1 a cash equivalent? Answer is, I'm going to give it to you because this is crazy enough that I should give it to you. Answer is what? Answer is no on this one. And the reason the answer is no is that what? It wasn't that they purchased it, that they didn't purchase it 90 days from maturity, so it is not a cash equivalent, right? They purchased it what? A year from its maturity, right? Now you take the T-bill 2, which is maturing what? On the same day, isn't it? It's maturing on the same day, but that one would be a cash equivalent. Yes, that one is a cash equivalent. And the reason that one is a cash equivalent is because it does what? It was purchased what? Only 30 days from maturity? So when you use that 90-day rule, 3 months that they give you here, will mature in 3 months or less, you got to be a little careful with that. They mean what? If you purchased it less than 3 months or less from maturity, then it's a cash equivalent. If you purchased it more than the 90 days from maturity, then it's not a cash equivalent, right? So it depends on when you purchased it, not when it's going to mature. Now, both of these are current assets, aren't they? They are both current assets, but only the one that you purchased within 30 days of maturity qualifies as a cash equivalent. Okay? Yes, sir.
As the maturity date comes closer, would it become a cash equivalent or no?
I'm assuming everything's at December 31st in this example. Okay, so they're both current assets, but the one that's the cash equivalent is the one that when you purchased it with the intent that it would only be a 30-day period, excuse me, in this case 30 days, but no more than 90 days, 90 days or less, to maturity. Okay, and the reason FASB's defining it that way is FASB's saying, well, look, if you have cash and you're just looking for somewhere to stick it for 90 days, then you really never gave up its cash status. You were simply trying to have a short-term place to put your cash other than a savings account. And so you decided to go ahead and put it into a T-bill. Okay, and this is my point about the federal government, the body snatcher people who say, they just default on their debt. That would be a financial disaster. The world looks to put its cash in Treasury bills on a short-term basis like this because they know that they'll be okay there. It'll be there for a few days before they need it again, for less than 90 days before they need it again. They're not going to put it somewhere else where, maybe there'll be some sort of entanglement and I won't be able to get it out. Okay, so they look for that. In fact, during the financial crisis, okay, in 2008, I'm sure you've heard about the financial crisis. I used to be on the audit of Treasury's debt. So during the financial crisis, I'm picking up the phone to my colleagues that were on that engagement with me, and I'm like, so what's going on over there at the Bureau of Public Debt right now? And they're telling me, dude, people are bidding negative returns. The way Treasury bills are issued, they're issued at a discount, and then they pay back at face. People were paying a premium on Treasury bills, bidding a premium. They didn't pay. They bid a premium on Treasury bills, even though they knew they'd only get face backs. So they were willing to take a loss in order to be able to put their money in Treasury bills for a short period of time. Now, the way the auction came down, nobody lost. They were all issued at discount because they make different bids. But they were willing to take a loss because at least they knew they could control what their losses were going to be during that point in time. And so it is a big deal if they default. So this is all at 12/31 that we would be doing this analysis of what is a cash equivalent. Okay. Now, I want to come down a little bit here because I have an example question. I'll come back to that one, but I had a better one. Come on. I know I stuck it in here. Really? That's frustrating. Okay, hang on. It's in the homework then. Let me just get the homework file out. God, that's irritating. I thought I stuck it in there. The fact that I can't find a file is not a good reason to take a break because I'm going to find the file in a minute and then you're going to miss the example of the good question because you're like, well, he's looking for that. So since he's looking for that, he's wasting my time. So let me go to the bathroom or whatever it is. And that's not the best decision. Okay. Of course, I'm still screwing around because it's not chapter 2, it's chapter 3 homework. Chapter 3 quiz. Okay, right here. Let me make that a little bigger. Okay, so you have this situation where you have a bunch of different things that are listed and trans policies to treat cash equivalents with high liquid investments with a maturity of 3 months or less. when purchased, right? What amount should trans report as cash and cash equivalents? Well, let's take the easy ones. Let's take the cash first. Is cash in a checking account cash? Yes, it is. So that's 35,000. Is cash in a money market cash? Still cash. In fact, it's in a money market. Doesn't make it not cash. Okay. Then you've got these two U.S. Treasury bills, and we're thinking, okay, these have the potential to be cash equivalents, don't they? So you have this first one, Treasury Bill, purchased January 1st, year 11, maturing February, November. It's purchased in November. Did I say that? First year 1, and then maturing January 31st, year 2. That's what I get for yelling at my dad for being confused this morning. I'm like, come on, Dad, stop being confused. He's 88, and I'm trying to make him 40 again, and it's not working. Okay, so what happens? We sit here, and November 1st, year 1, maturing January 31st, year 2. That's all of November, all of December, all of January. We're good on the 90 days, are we? From February, even if it's a leap year, okay? All right, so we're good on the 90 days. So is that a cash equivalent? Okay, so we go over, and that's 350,000. We got to take that one, don't we? As a cash equivalent now? Looking for cash and cash equivalents? Cash and cash equivalents? Right? Okay, good. Then you come over, and U.S. Treasury Bill purchased January, December 1st, year 1, maturing March 31st, year 2. So now that's all of December, all of January, all of February, all of March. Clearly not within the 90 days, right? But notice it's all about when they what? When they purchased it, isn't it? Isn't that the key point there? Okay, so when you add those three numbers together, I think you get this. Let's just, for sake of time, look at the answer. 460,000. Right here, guys. I just reposted the question there. 460,000. Question on that? Okay, now, when you look at something like that, you say to yourself, okay, John, that's one of those nerdy accounting things that I could see me telling my potential client that's the way it works, and my client would be sitting there saying to me, well, prove it. I mean, that sounds crazy. That sounds like you made that up. Are you sure? Okay, so what would you do? You'd go ahead and you'd go to the FASB codification. Okay, and just to make sure we're clear on where to find that for your material, okay, you go in. And you can follow that link. See the username and password is there for you, okay? And so you go in, and then what I like to do, just to make it a little brainless, is I just go ahead and I copy the username, right? And it works that way. Paste it in. And then I go ahead and I find the password. Did you ever hear that the guy who came up with the idea that these passwords have to have all this weirdness in them said, actually, they don't have to? I'm like, thanks, guy. Thanks, dude. After ruining all our lives. So we stick that in. We go to the FASB codification. I guess I could say yes, that I wanted to remember that password. I don't know if it will. And you got to accept, whatever. Okay. And for this one, what I would do is, and I did this earlier, guys. That's why it's already populated with that. You'd have to put in cash equivalent definition. Okay. And when you click on cash equivalent definition and you hit go, it gets a little confusing because you start getting all these things, but they're not directing you towards the definition. It starts telling you all the different places that cash equivalent is mentioned, a lot of it being in topic 230, statement of cash flows, because remember I said it makes a big deal in the statement of cash flows how we teach these cash equivalents. So it gets a little confusing because you're like, but I'm looking for the definition. I'm not looking for the nitty-gritty detail as to how exactly I'll use it if I'm preparing a statement of cash flows or whatever. So when you go to this master glossary, do you see master glossary over here? That's where you're going to get most of your definitions. And I'm going to just go to C here, obviously, for cash equivalents. And thank God the internet is working, or this whole example falls apart. And you come over to cash equivalent. Do you see cash equivalent here? Okay, and then it says generally only investments with original maturity of what? 3 months or less under that definition. Original maturity means original maturity to the entity holding the investment. For example, both a 3-month U.S. Treasury bill and a 3-month U.S. Treasury note purchased 3 months from maturity qualify as cash equivalents. Shut up, client. Any other questions? And after a while, they stop asking you those stupid questions, right? Okay? So that would be where you'd find the definition. Yes, sir? On the balance sheet?
Yeah.
It's a one-line item, often cash and cash equivalents. And we haven't gotten to the footnotes yet, part of Chapter 3, but we'll see that that would be under your first footnote in your financial statements is usually significant accounting policies, and you would call out, you basically would paste and copy that definition of cash equivalent as your footnote. Okay? Okay, guys, good work. Did I hand out the attendance sheet? Does it come back to me, please? Or sign in if you didn't, and we'll see you on Wednesday. We'll go with Chapter 2. Start to maybe take a look at the chapter. We'll finish Chapter 3. Start to look at the Chapter 3 quiz a little bit, too. Okay, and we'll see you on Wednesday.